at any point asked why the cost of Bitcoin varies from one trade to another. This might appear to be uncommon from the outset, yet very normal for any asset trades on an open, worldwide market. For instance, when Bitcoin rose to all-time highs in 2017, the information shows $19,600 was the greatest cost paid for the cryptocurrency on Kraken. Hello everyone, welcome back to my YouTube channel Crypto Lessons. Hopefully, you're doing well. In this video, we'll go through what crypto arbitrage is and the types of crypto arbitrage strategies and risks. Before we start our video, I would request all my new members to subscribe to our YouTube channel, so you never miss an update. So, let's get started. Remember this, the information contained herein is for informational purposes only. Nothing herein shall be construed to be financial, legal, or tax advice. The content of this video is solely the opinions of the speaker, who is not a licensed financial advisor or registered investment advisor. Trading cryptocurrencies poses a considerable risk of loss. The speaker does not guarantee any particular outcome. What is crypto arbitrage? Arbitrage has been a backbone of conventional monetary markets long before the rise of the crypto market. But there is by all accounts more promotion encompassing the capability of arbitrage valuable open doors in the crypto scene. This is in all likelihood on the grounds that the crypto market is famous for being profoundly volatile contrasted with other monetary markets. This implies crypto asset costs will more often than not go astray essentially throughout a specific time frame. Since crypto assets are traded all around the world across many trades all day, every day, there are undeniably more open doors for arbitrage traders to track down beneficial cost inconsistencies. A trader would simply detect a distinction in the estimating of an advanced asset across at least two trades and execute a progression of exchanges to exploit the distinction. Why are crypto exchange prices different? Centralized exchanges. The primary thing you should know is the valuing of assets on centralized exchanges relies upon the latest bid-ask matched request on the exchange request book. All in all, the latest cost at which a trader trades an advanced asset on an exchange is viewed as the real-time cost of that asset on the exchange. For example, if the request to purchase Bitcoin for $60,000 is the most as-of-late paired request on an exchange, this cost turns into the most recent cost of Bitcoin on the stage. The following matched request after this will likewise determine the following cost of the computerized asset. Hence, cost revelation on exchanges is a non-stop course of specifying the market cost of a computerized asset in view of its latest selling cost. Note that the cost additionally will in general shift since investor interest for an asset is marginally unique on each exchange. Decentralized exchanges. Decentralized crypto exchanges, nonetheless, utilize an alternate technique for evaluating crypto assets, known as an automated market maker framework. This straightforwardly depends on crypto arbitrage traders to keep costs in accordance with those displayed across different exchanges. Here, rather than a request book framework where purchasers and sellers are matched together to trade crypto assets at a specific cost and some decentralized exchanges depend on liquidity pools. For each crypto exchanging pair, a separate pool should be made. Each pool is financed by willful patrons who store their own crypto assets to give liquidity that others trade against in exchange for a proportionate portion of the pool's exchange expenses. The principal advantage of this framework is that traders don't need to sit tight for a counterparty, a contrary trader, to trade assets at a specific cost. Exchanging can be executed whenever. Across most well-known decentralized exchanges, the costs of the two assets in the pool, A and B, are kept up with by a numerical recipe. This recipe keeps the proportion of assets in the pool adjusted. This means that when a trader wishes to purchase Ether from the ETH link pool, he would need to add link tokens to the pool to eliminate ETH tokens from it. At the point when this occurs, it makes the proportion of assets change, more link tokens in the pool and less ETH. In a request to reestablish harmony, the convention naturally brings down the cost of link and expands the cost of ETH. This urges traders to eliminate the less expensive link and add ETH until the costs realign with the remainder of the market. In conditions where a trader changes the proportion altogether in a pool, executes an enormous trade, it can make huge contrasts in the costs of the assets in the pool contrasted with their market esteem, the typical cost reflected across any remaining exchanges. Types of crypto arbitrage strategies. There are multiple ways crypto arbitrageurs can benefit from market failures. Some of them are cross-exchange arbitrage. This is the fundamental type of arbitrage exchanging where a trader attempts to generate benefit by purchasing crypto on one exchange and selling it on another exchange. Spatial arbitrage. This is one more type of cross-exchange arbitrage exchanging. The main distinction is that the exchanges are situated in various locales. For instance, you could gain the distinction in the interest and supply of Bitcoin in America and South Korea utilizing the spatial arbitrage technique. Triangular arbitrage. This is the most common way of moving assets between at least 3 computerized assets on a solitary exchange to profit by the value disparity of a couple of cryptocurrencies. For instance, a trader can make an exchanging circle that begins with Bitcoin and closes with Bitcoin. Decentralized arbitrage. This arbitrage opportunity is normal on decentralized exchanges or automated market makers, AMs, which find the cost of crypto exchanging matches with the assistance of automated and decentralized programs called savvy contracts. If the costs of crypto exchanging matches are essentially not quite the same as their spot cost on centralized exchanges, arbitrage traders can plunge in and execute cross-exchange trades, including the decentralized exchange and centralized exchange. Statistical arbitrage. This consolidates econometric, statistical, and computational strategies to execute arbitrage trades at scale. Traders that utilize this strategy frequently depend on numerical models and exchanging bots to execute high-recurrence arbitrage trades and augment benefits. Exchanging bots are automated exchanging instruments that execute a high volume of trades at record time in light of predefined exchanging strategies. Crypto arbitrage trading risks. Certain elements could reduce an arbitrageur's possibilities, creating benefits. The generally safe nature of arbitrage open doors affects their benefit. Less risk will in general return low benefits. This is the reason crypto arbitrageurs should execute high volumes of trades to generate significant increases. Likewise, arbitrage trades aren't actually free. Fees. Recollect that arbitrage exchanging across 2 exchanges might bring about withdrawal, store, and exchanging fees. These fees might gather and eat into your benefits. Involving our unique model as contextual analysis, let us accept that the withdrawal fees of Coinbase, store fees of Kraken, and the exchanging fees of Kraken amount to an additional 2%. The absolute expense of executing this trade is $45,000 plus 2% times $45,000 equals $45,900. As such, the crypto arbitrage trader more likely than not brought about a misfortune, since the potential benefit is just $200. To moderate the risks of bringing about misfortunes because of extravagant fees, arbitrageurs could decide to restrict their exercises to exchanges with cutthroat fees. They could likewise store assets on different exchanges and reshuffle their portfolios to exploit market failures. For instance, Bob recognizes the cost variations between Bitcoin on Coinbase and Kraken and chooses to bet on everything. Be that as it may, rather than moving assets between the 2 exchanges, Bob as of now has reserves named in a TAI UST on Coinbase and 1 BTC on Kraken. In this way, he should simply sell his 1 BTC on Kraken for $45,200 and purchase 1 BTC on Coinbase for $45,000 UST. Toward the finish of this trade, he actually generates the $200 benefit and tries not to pay withdrawal and store fees. Here, the main fee that Bob needs to stress over is the exchange fee. It is worth focusing on that exchanging fees are somewhat low for traders executing high volumes of trades. How was the video? Please provide your feedback in the comments section below. I hope you enjoyed today's video. If you liked the video, please don't forget to subscribe to our channel so you don't miss an update. Press the bell icon to stay connected to our channel and enjoy meaningful content. I will meet you soon in a new video. Until then, stay happy and take care of yourself.